Well, welcome to another edition of the Rogers Capital Monthly Market Commentary, where we attempt to be the antidote to water cooler wisdom. For several months now, we've discussed expectations and market volatility. You've heard me say umpteen times 4 and 1 and 1 in 4, that 4 times a year we should expect a 5% pullback. Once a year, we should expect a 10% correction. And then 1 out of every 4 years, 5 years, we should have a bear market 20% reduction. April, we had that 5% pullback. May and June were rebounds from that. July was actually slightly up, almost 1%. That put us at a year-to-date of a little more than 15%. So through the first 7 months of the year, up 15+%. But of course, volatility is a part of investing. The last few days of July, and then of course now the first several days of August, have been pretty serious downturns. An unprecedented removal of a presidential candidate just months from an election, weeks from an election. But even from a actually market perspective, earnings, the Magnificent Seven, for example, not really coming through with earnings like we had hoped. There was also kind of an interesting rotation in the month of July, a rotation from the big tech names that we've all known, become accustomed to, Amazon, Apples and Googles and Microsofts, and into more of the dividend value stock names, the dividend payers, older, stable dividend payer type names. So that was kind of interesting, long overdue, but kind of an interesting shift. The big growth names being down pretty serious last month, and then pretty substantially, and then the value names being up substantially. But an interesting July, and of course, first few days of August, indexes already down pretty big. But let's talk indexes for a moment. The S&P 500, when you hear the market was down, you see it on the news, you hear me say it, folks are almost always talking about the S&P 500, which is an unmanaged index. It's just a representation, a gauge of what the overall stock market has done. And legitimately, those 500 names represent about 84 to 85, 86% of the wealth, the stock market wealth in this country. So it's a broad, barometer of how the market's doing. But I think most of you would think that the S&P 500 means 500 stocks, 500 names, and it's equally dispersed across there. And it couldn't be further from the truth than that. It is highly concentrated in the bigger names. It is a cap-weighted index. So your biggest 5 names: Apple, Microsoft, NVIDIA, Amazon, Meta or Facebook. Those make up over 25% of the index. Just 5 of the 500 names make up over a quarter of the index. And the top 30 names in that S&P 500 index make up over half of the index. So far from equally weighted, which means what? Well, those bigger names are driving the performance, which means that if you own those bigger names, it's a pretty accurate representation of how you're doing. But not everybody owns those names. So, important to know, it's not equally weighted. That's one index, the S&P 500. Another is the Dow Jones Industrial Average. When I started in this business 26 years ago, that's kind of the index that folks talked about. That's changed over the years, probably more the S&P. But When I started in this business, as the market was, I just remember it passing really landmark thresholds, 4,000 and 5,000 and 6,000 and 7,000, and how crazy that was that the Dow Jones was doing that. But the Dow Jones is a little different representation. It's only 30 stocks. It's the Dow Jones Industrial Average. So industrial stocks and companies, and only 30 of them. And it's much more equally weighted, though it is also not equally weighted. The top 5 stocks, again, make up a significant portion of the index. So United Healthcare is the number 1 holding. Goldman Sachs is number 2. Microsoft, Home Depot, Caterpillar. You can already tell that, other than Microsoft, those are different names that are represented there. So it tends to represent more of a value style, a dividend payer, more conservative style of index. So when you see the S&P's done one thing and the Dow has done another, that's why. The third index that has grown certainly in popularity in the last few years is the NASDAQ. Usually folks are talking about the NASDAQ 100, and those are the biggest 100 usually growthy technology names. So there's the difference between those indexes. They perform differently because they hold different names in those stocks, in those indexes. Now, you don't own an index. None of you own the index. In fact, the closest you can come is a passive ETF, an exchange traded fund that's tracking that index, but none of you own it. And none of you are in 100% stocks. I don't have one of you that's 100% in stocks, because we allocate between stocks and bonds and cash. Why? Because you cannot successfully be a successful investor and have all your eggs in one basket. And so when you see the market was down 4%, well, you're not down 4%. You don't own the index, first of all. And second of all, you only own a portion of what you have in the stock market, in the index that you're seeing there on TV or the internet. Okay? So let's talk a little bit about what we think the rest of the summer and fall is going to look like. My, how the narrative changes. We have for months now, over a year actually, talked about waiting on the Fed. They've raised rates, wanting to stave off inflation, kind of pull down the economy, maybe to a soft landing. You'll remember that term, soft landing recession, or at least in the last several months, hopefully even staving off an actual recession, but a little bit of pain. That's why the Fed raises rates, is to slow things down. And then, again, wow, the narrative just in 4 or 5 trading days has changed to panic that what the Fed has been trying to do is actually occurring, that the economy is slowing down, that we may have a mild recession, if one at all. So that watching the Fed and their monetary policy, hopefully rate cuts in what the market has bet on is rate cuts this fall, hopefully September. But the latest snapshot of the labor market is consistent with a slowdown. We have warning signs suggesting even more weakness. A number of those working part-time out of necessity, economic reasons, just rose to the highest level we've seen since June of 2021. And we expect economic activity to downshift even further later this year, this fall. Data reveals that consumers are pulling back more and more away from big ticket items, big travel. Even we're beginning to see it in the housing market as well. Now, the Fed is highly attentive to systemic risks in the financial system, even maybe what you've seen a little bit here in the last few days in the news, the carry trade with Japan lowering interest rates. But really, probably more impactful, the Magnificent Seven recently, kind of lackluster earnings reporting, but things have done so well, it's also kind of time for a little bit of a pullback. And when that coincides with lesser earnings, reduce, kind of a soft earnings reporting in the Mag 7, and, even the concerns about whether this AI spending and investment's going to pay off. Big tech is still expected to drive more than half of the earnings of the S&P 500 per share growth in Q2. In fact, 6 out of the 11 points of expected growth for the S&P 500. Fed could cut rates before the next meeting if they believe that the spike in volatility creates a more systemic risk, especially to the financial system. But overall, being prepared for market volatility is key. Since 1980, the market has averaged a 14% pullback every year. This is the way it goes. So that's it for this time. We'll see how August goes. Happy to talk. If any of this, begs more conversation on your end, hope you have a good rest of your summer as it winds down, getting kids into school here before too long. We'll talk to you next time.